This is Radio Now 95.3 FM. Come for the news, stay for informed conversations.
We return to economic matters here on your Beyond the News station. This time, the Debt Management Office announcing a change to Nigeria's medium-term debt management strategy, MTDS. It will see the debt to GDP ratio rise to 60% at the end of 2027. The increase is 8% more than the figure projected for the end of 2024. We're joined on the conversation this morning by Adegboyega Adebajo, who is an economist. Good morning, sir. Thank you for joining us on the conversation.
Good morning, Stephen. It's a pleasure to be here.
The pleasure is ours. Mr. Adebajo, what exactly does this change mean?
Well, it's first of all aligned with international standards. The DMO has been talking to the IMF and the World Bank in terms of indices which they have seen. And we shouldn't think of the GDP, the 60% max for GDP as being the only thing there. Now, this is particularly related to fiscal sustainability. One thing that, or a metric that's also been chosen is that the maximum interest payment will not exceed 4.5% of GDP. And even when the country is giving sovereign guarantees, which is like saying, if you don't pay, we will pay, that will not exceed more than 5% of GDP. So altogether, it tends to work out well, especially when you also consider that the aim is to have much more domestic debt, and that's borrowing in naira rather than borrowing in dollars.
So, sir, I guess maybe the next question would be around the ability to sustain this new projection. And by sustaining, I'm really talking about ensuring that there's no external or executive influence over the DMO and its ability to raise a red flag if at all we're crossing the line.
It's going to be difficult to cross the line because whoever we're borrowing from is aware of these statistics, is aware of these metrics, and it will certainly be a red flag if Nigeria goes knocking on the door of an international organization to borrow, because they're going to be looking at the entire risk mix there. This is linked to projections in terms of the country's ability to pay, and also to manage its budget, well, the fiscal part of its budget. So, yes, I mean, it's fine if we feel, hey, let's go borrowing a bit more, but then who's going to lend to you when you've reached the maximum of your limit and the metrics you set? It will show real fiscal indiscipline to do so.
We understand that this comes with an increase on interest payments to GDP, so it's going up from 3.75% to 4.5%. As much as we're talking about limited exposure to external markets, what are the exposures for the internal market?
Well, okay, so in terms of the internal market, right, the idea is to have, like I said, greater domestic debt. Right now, domestic debt is about 48%, external about 52%. The idea is to bring down external to 45% and increase domestic to 55%. That's the mix. Okay, so out of the total 100%, 55% will be domestic and 45% external. And in terms of long-term to short-term ratio, right now the aim, the target is to have a minimum of 75% long-term domestic debt and external debt long-term 25%. So these are very interesting mix in terms of the metrics. And, you know, the idea here is borrow more in naira, bring new products into the market. There's a lot of money locked up in the banking system and non-bank financial institutions, because remember, the CBN has a cash reserve ratio in banks of about 50%. So for every 1 naira you have, you can only lend 50 kobo. Now, what's going to happen to the other 50 kobo? So the idea is the government should use it to fund its activities. Yeah.
I imagine that this also requires the CBN to be a lot more vigilant because, again, I'm coming back to what the internal risks could be if we don't align with the parameters that have been set. So we've seen everything from, and pardon my layman's perspective, but I think about how borrowing and lending happens in private businesses and with regular individuals in the country, right? So if you have a federal government that's excessive and this pressure is brought to bear on the local market, what those exposures could be, especially in terms of things like inflationary pressure, the risks to debt servicing, all of this coming up together.
Well, you're absolutely right about this, and that goes again to fiscal indiscipline. And I guess we're all witnesses to what has happened previously with the government printing more money and using much more cash than was budgeted for. There's a big question mark here. I would not expect in the current circumstances that we would go that way. The government has a target of building up the GDP, creating up to about $1 trillion. That's the big word. That's the big picture, which we're working towards. The target for inflation is to come down below 20%. We're still above 20%. Mm-hmm. And we're barely 3 months to the end of the year, 3-4 months to the end of the year. Will that be achieved? The chances of that, it's up in the air. But for some of us, we're thinking, no, it's not likely that will happen, not with the way food prices will tend to go up after the rainy season is over, hoping the flood doesn't bring about instances to push up the prices of food. We need to keep an eye on inflation. And I'm hoping that the Debt Management Office, set up specifically to provide this kind of oversight and advice to the government, will be up to what they're expected to do.
Mr. Adebajo, thank you very much for your time and expertise on this conversation. Adegboyega Adebajo is an economist who joined us this morning to speak on the changes that have been instituted by Nigeria's Debt Management Office. These changes specifically affect the policy around Nigeria's medium-term debt management strategy. It will see an 8% increase of Nigeria's debt to GDP ratio by the end of 2027.
This is Radio Now 95.3 FM. Come for the news, stay for informed conversations.